Have you ever watched price explode upward or downward with incredible speed, only to jump into the trade because you were afraid of missing out? A few minutes later, price suddenly reverses, hits your stop loss, and continues in the opposite direction. This is one of the biggest reasons many traders lose money. They trade based on emotion instead of structure. They see momentum and assume the move will continue forever without understanding who is actually driving the market. In this lesson, you're going to learn how to trade with structure by understanding the interaction between market participants through auction market theory. If you haven't watched my previous lesson on auction market theory part 3, where I explained initiative participants and responsive participants, I highly recommend going back and watching it first. Now let's focus on responsive participants and how they trade. Responsive participants are traders and institutions that operate at the extremes of value. Instead of chasing price, they wait patiently for price to reach an area they consider valuable before taking action. What do we mean by value? In simple terms, value can be represented by supply and demand zones, areas where strong institutional buying or selling previously occurred, causing price to move aggressively away from that zone. Let's look at a simple example. Imagine initiative participants enter the market and aggressively buy. Their buying pressure pushes price upward with speed and momentum, breaking previous market structure and attracting the attention of retail traders. Many traders see this strong move and rush to buy because they fear missing out. However, while these traders are chasing price higher, responsive participants are patiently waiting at a higher supply zone. As soon as price reaches that area of value, responsive participants begin selling aggressively. Their selling pressure overwhelms the buyers and pushes price back down toward another area of value, such as a demand zone. This creates the constant back and forth movement we see in the market. Initiative participants push price away from value. Responsive participants push price back toward value. Understanding this interaction allows you to stop chasing price and start trading with structure. Now, the important question is, how do you know when responsive participants are actively defending a supply or demand zone? Here are 5 powerful signs to watch for. 1. Strong rejection from value. Price reaches a supply or demand zone and immediately reacts with strength. At a supply zone, price is rejected downward aggressively. At a demand zone, price is rejected upward aggressively. This shows strong participation from responsive traders. 2. Retest and rejection. After the initial rejection, price often returns to test the zone again. If responsive participants are still defending that area, price will reject the zone once more and move away. This confirms that the value area remains valid. 3. Strong displacement away from value. Look for powerful momentum candles leaving the zone. Large-bodied candles with strong conviction indicate that institutions are actively participating in driving price away from value. 4. Change of character, CHOCH. A change in short-term market behavior is often one of the first signs that control is shifting from buyers to sellers or sellers to buyers. This tells you responsive participants may be taking control. 5. Break of minor structure. Once price begins breaking smaller swing highs or swing lows after rejecting a value area, it provides further confirmation that responsive participants are influencing market direction. These 5 signs can help you identify when responsive participants are defending a supply or demand zone and potentially moving the market. But there is still one major challenge. How do you align these signals across multiple time frames? That is exactly what I'll be covering in my upcoming lesson.